All right, guys, it was a pretty flat day in the stock market today. That comes on the aftermath of a 2% sell-off in the S&P 500. Pretty heavy day yesterday following the FOMC minutes. It was a flat day yesterday as well, but once those FOMC minutes came out, it totally changed the picture on what we've seen from the Fed in terms of December 15th. You had the FOMC statement that came out followed by the presser. It was a lot different picture that was being painted back then. They were talking about, okay, we want to finish tapering in March. That'll leave us the opportunity to perhaps raise rates in May. Now they're talking about accelerating it even faster and trying to raise rates maybe as soon as March. So why did he not even just say that at his presser and in the statement? Why does the statement almost look like a completely different outlook than what the minutes portray? So that's what caught the stock market completely off guard and created that huge rush for the exits. In fact, for the NASDAQ, from a dollar standpoint, it was like the biggest day of selling in over a decade. That I'm not talking about from a percentage standpoint. I'm just talking about the sheer amount of dollars or stocks being sold, the dollar value of those stocks, biggest in over a decade. So that is a big cause for concern. There's a lot of people very nervous about being in the tech stocks right now, and it's still being reflected today, where you still saw the NASDAQ sell-off, couldn't really muster a bounce. The S&P 500, it finished slightly lower as well. The only one that really did okay was the small cap index with the Russell 2000. Let's go ahead and go right to the charts here. Remember, I'm going to be taking all of your questions. You're looking at your charts, your stocks. I like going over them with technical analysis. Just post them down in the comments below, and I'll get to each and every one of them. Let's go now to SPY. This is the S&P 500 ETF. You have a pullback that was taking place yesterday to this breakout level. Remember, 4,700 was a very, very difficult area for it to break through. 4,700 for SPY. It continued to hit its head off of it. It would even break above it on an intraday basis, but closed right back below it by the time the market finished the trading session. And then right before Christmas, we break right out, and then we follow through with it 2 days after Christmas. So now we get a whole bunch of consolidation. We get the sell-off yesterday. Now we have a break back below it. So what did you see today? Well, we saw a support level and a resistance level coming into play. We saw support at the 50-day moving average come into play, and I'll get into that in just a second. But we also saw resistance, that old 470 on SPY, 4,700 on the S&P 500 come into play. So it couldn't break through it to the upside, couldn't break below the 50-day moving average to the downside. That's this red line right here. And the reason why the 50-day moving average is important, last 2 times it's had no problem breaking below it, but there is a strong history going back to the beginning of last year. You got January, you got February, you got May, June, July. You got it again in August. I mean, it's almost on a monthly basis. It would test this 50-day moving average and bounce right back up. It wasn't until September, October where we saw a substantial time period where the stocks in the S&P 500 specifically was trading below the 50-day moving average. Now, the S&P, it's been down 3 straight days, 5 out of the last 6. You would think, but here's the thing though, it's really not that far off of all-time highs. We're talking about 2 or 3% off of all-time highs. But where does the rest of the market stand? The T2108, 46%. This is the 40-day moving average indicator. 46% of stocks are trading above their 40-day moving average. That means about 54% are trading below their 40-day moving average. Now, probably the more important one in this particular situation is the 200-day moving average, because remember, SPY is way above its 200-day moving average, not even close to breaking below. And in fact, it hasn't been below the 200-day moving average since June of 2020. So we're talking about 18, 19 months here since the last time SPY even thought about going below its 200-day moving average. But you have 57% of stocks trading below their 200-day moving average. Only 42% are trading above it. That is a big, big concern there. And you can see here, it's not just something that started happening. Going back to December of 2020, it has been a steady decline of stocks trading above their 200-day moving average. Less and less stocks are participating in this rally than ever before. So we're talking about tech stocks selling off. they're just finally seeing some selling. They were pretty much what was holding up the market. And today, when you had the market kind of flat and the small caps higher, you still saw some weakness in Apple. So on Apple, I'm kind of thinking we're going to see maybe a retest of this 163, 164 level. If that doesn't hold, then I would get very nervous that maybe we're going to see a retest this bottom channel. I think it's very possible. I think all of these stocks are overvalued, particularly in the tech space. You're seeing stocks like MSFT start to roll over here. I mean, look at that. That's a triple top there. First top, second top, third top. Triple top, it's considered, the mark of a top in a particular stock. It's selling off. You take Google, very similar chart pattern, doing the same exact thing, breaking below that triple top pattern here. Then you have Facebook, which actually was up today, but it hasn't gone anywhere in the better part of like 4 or 5 months. I mean, since September, it's done nothing. In fact, it's lower than where it was back in September. So it has struggled. It's kind of congregated around this 200-day moving average, but even with 2.5% trading higher, I don't necessarily think that makes it a good trade setup to be jumping into. It's got a lot of resistance here going on. It needs to get back above this layer of resistance at around 354. Until that happens, it's no go. So what were some of the sectors that were helping with the market today? Where were the ones that people were jumping out of? Well, up here on the top right-hand side of the screen, you're going to see energy, and you had financials. They were your big movers today. To a lesser extent, consumers are discretionary, not tons, but a little bit of bullishness and discretionary. But your main runners today were financials. They're benefiting off of the higher interest rates and energy because the price of oil keeps going up. What were the losers? The big losers were utilities and healthcare. Now check out healthcare. I mean, this one is putting in consistent lower highs, lower high here and a lower high here. You got lower lows already with the one that was put in back in December and the one that was put back in October. So this sector is pretty much been bearish for quite some time. In fact, it's in correction mode because it's pulled back over 10% from its September highs. So we're going to want to watch how does healthcare perform when it retests those December lows. Now, one of the big drivers in healthcare, and the reason why it was so weak today, was Humana. They're just basically saying, we just think that it's a very tough sector right now. With the healthcare plans, we're not expecting a lot of big profit drivers. We're just feeling like business is going to stay the same. Nonetheless, market didn't like that. Drops 20% today. Massive. And so anytime we're not seeing like unbelievable earnings and people are kind of like bringing you back down to reality a little bit, like saying, hey, this is the real reality of our business, you're going to see a lot of shattered dreams get broken and stocks just really, really sell off. So I don't like Humana at all going forward, guys. You want to try not to buy the dip on these things. Just because it's selling off doesn't mean that it's the right time to buy. You want to wait for a base to start to form, because when I zoom in, this is a broken support level there. Maybe it can recapture in the days ahead. It needs to. If you're a bull, if you're long on this one and you didn't have like any risk mitigation plans in case something like this ever happened, well, you're kind of bag holding at this point, hoping that it can, find some buyers around here. But this was a major support level that the buyers did not step in at. So it makes you wonder, how much further does this have to drop? Because there's not a lot of support right now until you get maybe to around 339, 340. But it wasn't just Humana. I mean, if we go and we look at all of the different stocks within this sector, you're going to see that there was just a ton. And I got to pull it up here. It's not letting me pull it up at this moment. Let's go to capitalization. But yeah, United Healthcare, it was down 4%. Pretty much all of your healthcare plans were down today. Now, utilities, I mentioned utilities being down, second weakest sector today, down 0.8%. Pretty good move here. Usually when you see a notable sell-off in the stock market, stocks or money will flow into staples, it'll flow into utilities, and it'll flow into telecom. And that was not the case here. Instead, what we saw here was a continued pullback in utilities, and utilities have been hot, and it was mainly because of NextEra Energy. But what did NextEra Energy do today? It broke its rising trend line yesterday and continued to the downside today. You had some major support here that it needed to catch a bid on. and it didn't. The buyers did not step in. So you're seeing more and more support levels right now in the market continue to get ripped. So that's the problem with NextEra Energy. I like this stock a lot. I think it's a good company, pays a dividend that's pretty respectable, but right now it's just in a free fall. All right, so that's kind of like the analysis I would give on the market today. As far as tech, because a lot of people are saying, okay, when is the time to start buying tech stocks? Well, let's look at it. We talked about Apple, and we talked about a number of the other FANG stocks still struggling. But when you look at the software industry, they didn't do too bad today. Maybe a temporary bottom here could be in place at the very least. It seemed like it wanted to hold support going back to, gosh, it looks like about November of last year. So you had this support level that was broken, and then you had another one that kind of kicked in today, and it's kind of holding its own at this point. I'm very, very concerned about the market right now. I mean, we keep seeing the dip buyers come in, and they'll keep propping back up. I have some long positions myself. I also have a long position in TWM, which is the inverse of the Russell 2000 or IWM. So I've got kind of a balanced approach today. It has served me well, quite frankly, throughout this week. Doing fine overall in the week, but software, I'm still watching it. I'm trying to find some stocks that have some good basis for me. Just not quite seeing it out of a lot of them yet. But then you look at semiconductors, and semiconductors are they put in a good day today, up 1%. So what was the drivers there? Well, you got an NVIDIA. NVIDIA, you want to watch this declining trend line right here. And it essentially recaptured this support level here, and almost say, even though it dropped below it yesterday and closed below it, it was able to recapture it today. So that's a very positive sign. So now what you want to see out of NVIDIA is, can it push back up to 304.60? And don't forget, folks, keep posting your stocks in the chat room. I see all of them regardless of the platform that you're on, and I will get to each of them. But NVIDIA breaking below support, recapturing it, but it needs to get back above 303 in order to consider getting long on it. It gets above 303. Maybe I put a stop loss below this support level here that's continuing to rise higher. And then we also have KLAC, bull flag pattern here. Looking really good. Like I said, the semiconductors, they were up 1% today. KLAC was a good big reason for that. And it's got a little support right here too in the short term. So there's a lot of short-term developments that's in KLAC's favor. But as always, you gotta manage the risk. You gotta have a stop loss in place. So something like this, probably even getting long after it breaks out of the bull flag, maybe around like 435, and then putting a stop loss around this 417 level. And the last one that I want to go over is Moderna and its trend line. See here, a stock once at 500, down at 216. It's been cut in half, pretty much like a 60% pullback from its all-time highs. That's more than correction territory. It's pretty much crashed. But look at this. Look at this rising trend line here that's formed. Yes, it's got a declining trend line too, but that's way above current pricing. But this trend line here is trying to hold. So maybe the bulls can step in here and give you a decent bounce play. But if not, I'd probably use the lows of today as my stop loss. So it's a company, I don't have faith in it from a long-term perspective, but it could give you a little bit of a relief rally. Now, let's go and look at some of your questions here. The first one here, let me raise my face here. How you doing? So my thing is, I tried going long on stocks last year, and every time I got crushed into the negative. This year, I'm just going to wait on overextended stocks and short it. Advice? Well, you got to remember, a lot of your stocks that get overextended, they can stay overextended to get even more overextended as the rally continues. And there's an old saying that says the stock market can stay irrational a lot longer than you can stay solvent. It's a very popular strategy. There's a lot of people that do it, but there's a lot of people that get crushed on it too. It's not my favorite. It's like trying to step in front of a freight train and hope that it's going to stop before it hits you. And that's why I'm a little bit opposed. Not even a little bit. I'm very much opposed to trying to short overextended stocks, because they can get very much more overextended than you'd ever expect. They can do these crazy gaps higher. I mean, let's look at Tesla, for example, right? And we had somebody asking about Tesla, so we can go over that one real quick as well. Look at this rally here. So I would say, let me just go ahead and take all the lines off of it. When it starts getting like this, at that point, I'm thinking, okay, it's starting to get overextended, right? I mean, you rally about 6, 7 straight days in a row, and you're thinking it's gone from 780 almost to 870. So good 10% rally in a short time frame. It's overbought. Then you get this move up to 900, and you're thinking, okay, it's definitely overbought. I'm going to short here. But what does it do? It goes up to 1100, and it just keeps moving. So maybe you were, able to make a little bit of a move off of this move from 1080 down to 1012, but you're really just, in hindsight, that's really just trying to find one area that you could have maybe made a profit off of it, and most likely nobody would have shorted it right there. And then it just keeps on going. So let's say you got in at around 900 because you thought it was overextended. Now you're looking at 1200, and a good chance at a margin call. You're down 33% on the trade. And then you get out because you're thinking, man, this thing is never going to come back down. As soon as you get out, it drops. So I think you got to be really careful about trying to short overextended stocks. They don't always fall when you expect them to. And then when you get out of the stock because you can't take the pain any longer from shorting, it finally does drop. I only say that because I speak from experience. I've learned all these lessons the hard way over the years. That's why I'm here. I'm trying to help you guys out some. But where does this Tesla chart stand right now? You had this big bull flag. We gapped out of it, but it's done nothing ever since. It's filled this gap. And I mentioned before, like, there's a good chance that it could do that. Don't go chasing Tesla at this 1100 level because there's a good chance it's going to come right back down. And sure enough, it did that. And it almost went below 1,000 here today. So it's back in the bull flag pattern. I don't even really like to consider it as a bull flag at this point. I like to look at this as there's a clear resistance level now overhead. It needs to get back above 1215 to really separate itself from this nasty messiness that we're seeing on the chart. If you get long on it at this point, what's your end game for it to go back up to 1200 from 1074? Maybe you play it with a break of today's highs at 1086 or so. You get back up to 1280, 1200. You make a good buck, maybe about 10%, but you're also probably risking more than I would prefer to risk on the trade to justify that reward to risk ratio. And so a lot of times when you get frustrated with the stock market and everything, look at why are you losing on the long side of the trade. Remember, and it goes back to what we talked about in the beginning of this live stream is that a lot of stocks were not participating in the market this year. Less and less stocks participated as the year wore on. So if you're just looking at it from a numbers game, the chance of you being right on a trade was going down as the year progressed. The best time to win on the stock market was in the beginning of the year when the most stocks were participating. But as the year progressed, less and less stocks were participating, even though the market was going up. In fact, it was just a handful of stocks there towards the end. It was like Apple, it was Tesla, Microsoft, and Google. It was just big tech that was really rallying the market, in your semis like NVIDIA, AMD, KLAC. And most other things just weren't participating, maybe except for Home Depot. Did you guys see Home Depot last year? Stock was insane. Really good year for Home Depot. I got in on a little bit of that action right there, but it was just a handful of big companies. And because their market cap was so big, they were able to overshadow a lot of the weakness in other stocks. So, and to further to this person's question, he says, because if I look at the stock list, my short stock list, and if I would have gone short it, he would have made so much more money. But a lot of it comes down to the psychological side of trading. Were you chasing money, or were you chasing breakouts well after they had already occurred? Were you getting that FOMO feeling, playing like GameStop and AMC? Those are good questions to ask yourself. All right, Paul Phillips asks, SSNC. So you have the breakout level. It's sustained. It's held together really, really well. I mean, this is one of the few stocks out there that's continues to put in new highs, right back to its all-time highs from the end of last year and the beginning of this year. Yesterday's sell-off was a little bit brutal, but it was brutal for most stocks, particularly tech. And it's in software. Software stocks have been taking a beating, so there's a lot of strength in this one. And definitely worth keeping on the radar. I think the next leg, or you're looking at a secondary breakout, if it can get back above about 83.28, if it gets back above there, I'd use this rising trend line here as my stop loss. So 83.28, you could probably use like a stop loss of 81.13. I'm going to write this one down for my own self because I think it's a really good trade setup there, that if you can capture some of that momentum on a breakout, I don't know how high it'll go for you, but I think considering that you're only risking a couple of bucks to the downside, I could see where this stock could go up to $87 in short order. Good stuff. CVS, not CVX, but CVS. Nasty little sell-off there today. Not worth chasing at this point. CVS, for me to get long on, needs to come back down to this rising trend line that it's tested in the past. It's way disattached from that trend line. Needs that pullback. We've seen, like with NextAir Energy, stocks that have had some of these similar patterns, they're starting to show signs of pulling back. CVS in itself was down 3% today. So I would wait for that. I think if you're long on this trade, start looking at this 10-day moving average. It broke below it today, closed below it. It was using that as support going higher, and now it finally closed below it. So that would be a little bit of a concern for me as well. We got JCI. Nice consolidation. Again, it needs to break above this 81.35 level. But again, it's holding up pretty well to some of the market pressures. This is probably another infrastructure play that, if the infrastructure bill does pass, you could probably see a good rise in that. Then we got EQR. Nice short-term trend line there. I would say that's going to be a level of support as well going forward. Not familiar with this one. I don't know what its dividend payout is or anything else. A lot of these REITs will have dividends, which is one of the main reasons for getting into a lot of them. But REITs as a whole, they're very overvalued. So they've been just on an incredible tear since the March 2020 lows. And then to the last of Paul's, let's see, PHO, the Water Resource Portfolio. I'll look at it from a technical standpoint. Nice trend line here. Let's see how far back it goes to. It looks like it just goes back to March of 2021. I would watch, if you're looking to get in on it, I would look to get in at around 57, 52. If somebody's long on it, I would probably say, hey, if it breaks below this support level here, that's where I'd probably be concerned because it's putting in new lower lows. Breaking below this key level here would be a good reason for me to get out of it. And I agree with Nikolopoulos. Choppy markets are rough, man. They're not easy markets to trade at all. The less choppy, the better. I don't care if it's bullish or bearish. I just want to trend to trade, and choppy markets don't make that very easy. Let's see, energy stocks, XOM. All right, so we got a rise off of the looks like the October lows. Really good. I mean, XOM, it's like Chevron a lot in the sense that it has a really good dividend to it. Pays really good, pretty reliable, pretty stable. But XOM, you don't want to go chasing it here after it's been up for like 5 days in a row. You really want to look at, can I get in on a pullback here? The energy rally, that boat's already sailed, right? Maybe it keeps going up higher and everything, but if you start trying to get in at these levels, you're setting yourself up, for a decent pullback against your position. You want to get in as it's starting to break out. I mentioned before, when that energy started breaking out, this was one sign right here, breaking out through, long-term resistance. That was a good sign there. I got into Hess on this rally. I sold another third of that position today at, I think, 84.04. So I have about a third of a position left on it. And I got in when it broke this declining trend line here. So it breaks out of it. And that's the time you want to get long on it. You don't want to be trying to get long on Hess right now. I wouldn't buy it at this level here, but I'll manage the position still. You know, it has a 5-day moving average. It's running pretty higher, but you don't want to initiate a new position right there. So going back to XOM, don't want to initiate a new position just yet. It'd probably be better for XOM to pull back to, you know, the lower 60s before looking to get long on it. And you always got to love these characters here. It says, I've been calling for a bear market since 2019. I said, no, 2019. I was like, no, that's definitely not true. I've looked at, there's been bear markets in terms of like short-term blips on the radar, like what we saw with the COVID sell-off, what we have seen with the 2018 sell-off in Q4. But I think anybody, sane person listening to me do these things, I'm not being a person that's trying to freak people out at all. And I only bring that up because I don't want to be a person that runs from somebody's criticism. If I think it's fair, I'll say it's fair, but I'm trying to profit just like everybody else is every day in the stock market. PLTR, this has got a lot of people in a bind right now. So it broke below some key support there, but then you push the support level a little bit further down, you get a little bit clearer picture just how problematic it's getting for PLTR. I don't like it. I've been saying, hey, if it breaks the support level, I'd probably go ahead and get out of it. There's just it could have been a good opportunity, and I had it as a long setup at one point, and it never triggered. But if it could have broken out of this base here, I think like around 1950, it could have been a really good opportunity, but it didn't do that. Instead, one, it never confirmed to the upside, and then two, it broke down pretty nasty yesterday, and you're catching a falling knife at this point. Essentially, support for PLTR. Let me see if I can get the picture off there. Support for PLTR goes all the way back to the October of last year lows when it came out as an IPO. That's what you're waiting for right there. So I definitely wouldn't go chasing after it. Or not chasing after it, trying to catch a falling knife. Got to get my terms right. All right. So analysis on DBX and T. DBX, you got a big time inverse head and shoulders pattern here. So you got your left shoulder right there. Then you got your head. And then you got this tiny right shoulder. Now you're like, well, the right shoulder is not as big as this left shoulder. Most of the time it's not. Usually the right shoulder being a little dilapidated or not equal in size to the left shoulder is a good sign because it just shows you the support. When I say good sign, it's a good sign if you're trying to short the stock as a short play. But it usually means that there's just nothing left in the tank for it to even put in together a right shoulder. A head and shoulders pattern as a whole is a sign that buying enthusiasm is completely waning on it. So big topping pattern there. I don't have any desire to play this bounce. Now we have seen over the last 10 plus years a lot of bounces off of this neckline. They call this the neckline of the head and shoulders pattern. You see a lot of bounces off of it. So when you zoom in, you can see maybe it's trying to do that. It didn't necessarily break below it. It held it today. It snuck below it a little bit, sucking some of the shorts, and then closed in the green just above the neckline. So maybe it does bounce there, but not my favorite play. I don't like taking a bearish pattern and trying to make it a bullish trade signal. Shopify, and I actually posted, I think, something on my Twitter account about it, how it's kind of getting ugly. Again, not trying to scare people, but I mean, I'm just looking at the charts. I mean, I don't make the charts. I just read them, right? You had this rising channel, everything looked pretty good on it, but then you started getting like what looked like a head and shoulders pattern. It did confirm to the downside. We can go ahead and get rid of these things now because they're not relevant to the trade or to the chart. Really, one thing applies at this point is this big support level. It's broken below it. Where are the next support levels at that we can target? Maybe right here where it's currently trading at. You can see here, there's a little bit of support here going back in late 2020 or second half of 2020, but it breaks below it, but it doesn't quite fall apart. It almost congregates around it, just, you know, going up and down, up and below the support level. Now it may try to bounce there. Even if nothing else, it may just try to give you a dead cat bounce. So hit that support level and go right back up to maybe this resistance level before continuing to downtrend. Long term, let's look at the weekly chart on this one, just because I'm curious. Did it break all of them? Yeah, I mean, it's breaking that support level. This is interesting. You're seeing a lot of charts that nobody really talks about it anymore because it's just so disattached from reality, but because of the whole 2020 epic run that we saw. But you got this long-term trend line here that hasn't been touched in about 18, 19 months. Could what we're seeing in tech lead a lot of stocks to start retesting these massive long-term trend lines that it's just completely left in the dust over the past 18 months? That's going to be a real interest. I actually think if you get Shopify below this level right here, like around 882, it's going to suction itself right back down to 710. That's still a long ways away, but I mean, it was trading at almost 1800 now at one point just a couple of months ago. Now it's at 1100, 1200 bucks a share. There's actually sell-offs that'll last a couple of years. NASDAQ.com bubble, when it popped, NASDAQ was down for 3 years. So was SPY. You had the March, not March, but the S&P 500, and when it had the financial crisis back in 2008, that was a solid 13 months or so of just straight selling. I mean, there was a couple of months where it had dead cat bounces, but overall in the year, it's pretty significant. I think the worst bout of selling really that we've seen was probably Q4 of 2018. Since then, I think there was a summer of 2014 where you had some European banking issues, but I would say, a lot of people are not prepared for a really bad pullback if it's to come right now. If it's to come right now, we're in the early stages of it because we were barely off of all-time highs, and you can't really call it at this point in time because there's just not enough technical damage on the charts to get super bearish. Let's see here. What do I think about RIOT? Pull up the daily chart instead of the weekly. Key support here is a broken. Let's tighten up this line a little bit. Yeah, it's definitely broken. Question becomes, where does the next support level come? I mean, you could say that's a support level, but it's really just one data point, guys. I think what I would probably do on RIOT is I would wait for a little bit of consolidation first. I mean, you wait for that consolidation to come in, you get some nice consolidation, and then play the breakout of that consolidation. Because right now, there's just no real support to play off of. And it's below this major support level. So I don't really want anything to do with it at this point. MU, the stock went from not being able to catch a bid for most of 2021 to November, just ripping the face off of shorts, going from 72 almost up to 100. Bull flag here, or not even so much that, more like a continuation triangle pattern, broke to the upside, and it's holding up pretty well. I mean, like almost all stocks yesterday, you're seeing this nasty candle right there. But I would say it's the same thing. You got like a secondary breakout here that might happen at over 96.65. Yeah, it could keep going higher, especially if semiconductors and the technology sector as a whole can rebound. You saw the rebound in semis today. Maybe technology follows tomorrow. Did net hit support today? Well, let's just see. But broke that trend line. You got that's all right. I'm going to go off of this support level right here. It looks like it's just a shade below it. Maybe there's a chance that it can break right back above it tomorrow, but you're seeing a lot of volume pouring into it. Before getting long on it, I would probably say wait to see that it wants to bounce before actually trying to play a bounce off of this support level. It's oversold. I mean, no doubt about it. 9.2 on the stochastics reading. If you look at the weekly, I mean, it's pretty rough too, but let's look at the weekly a second here and see if, ooh, look at that. See, sometimes you got to zoom out and you can find some really interesting tidbits on charts. That's just me typing in weekly chart, not typing it in. I just hit a 5 on my TC2000 chart, which if you're interested in it, there's a link for it down below. But yeah, this is kind of an interesting one. I'm going to add this one to my watch list as well. If you go back to the daily, you can see this chart here that I just drew. Goes back to September 2020. It's testing it. That's kind of interesting. definitely worth watching. I like it if it can actually bounce. It needs to show us that it's willing to bounce. Right now, it's not doing that. A lot of heavy volume. So will the support hold? Just because the support doesn't mean it has to hold. It's a guidance. Okay, if you see it bouncing off of it, there's a chance that the buyers are finding that area, like it has in the past, a place of value. But you can also find long-term trend lines like what we have here in Netflix. This goes back to the March 2020 lows. Did it support that trend line? No, it broke right below it yesterday and continued to the downside today. So glad to help you chart it up. He's been watching the podcast. If you haven't checked that out, go to Swing Trade in the Stock Market on Apple or Spotify or whatever platform you listen to podcasts on, and you can get my podcast. There was a new one that came out yesterday. So be sure to check that out and send me emails, Ryan at SharePlanner.com. If you have any questions that you want me to do an episode on, I do them on almost everybody's emails, believe it or not. AAL, we haven't looked at this one in a while. Let's look at this one and we'll wrap it up with it. Let's look at, first of all, let's look at Jets. This is your global airline ETF. Tried to break out back here in November, couldn't pull it together. Now you got like a little double bottom. And the reason why I go to Jets instead of looking at AAL first, it gives me a feel for what the industry as a whole is doing. So it's in the industrial sector, so you can always look at how the sector is doing, as the industrial sector is doing as well. If you look at it, pretty good. It's up against some resistance here and needs to break out there, but still a pretty healthy chart. Jets, JETS, double bottom, could face some resistance here at 23.28 or so. It's declining, hasn't broken out of it yet, but pretty solid base that's forming there. So we got the sector and we got the industry, both pretty healthy. Now we need to see what is AAL. And when I say healthy for Jets, short term, it's looking better. Long term, it's still stuck in this declining trend line, but it may be looking to make a new play to push above that declining trend line. So AAL, very similar chart as Jets, namely because it's an airline stock within the Jets ETF, declining trend line. So if it rallies, 21 is going to be some resistance. Now, is there an opportunity to profit in the meantime? Yeah, I mean, you've got about 10 to probably close to 15% or so, or 12% or so there if I'm just winging it mathematically. Little short-term rising trend line there as well. I would wait to see if it gets back above $18.98, let's say $19, and then you can put a trend or a stop loss below like $17.98. So that gives you about 5.5%, 6% stop loss, trying to get that 12% to the upside, and then you can sell it right at that point there. So Alex actually follows up and lets me know that he's in at 19, stop is at 18. Okay, that's pretty good, man. I could go with that. I would probably just use my stop loss. If it's me doing it, I'm using the lows from probably the last day of the trading year, 12/31. All right, guys, that's going to do it. Make sure to pound the like button. Make sure to subscribe so you get these notifications in the future. Guys, I'm doing these as much as I possibly can. I'm usually targeting Tuesdays and Thursdays with you around 4:30 Eastern time, which is just after the market closes here in the U.S. Gives me a little bit of time to get my notes together. Keep bringing the questions, man. And I've really like doing this with you guys here a couple times a week. Hey, I picked up NET from you guys here as a good idea. And a couple of others that I need to start watching. So thank you guys and God bless.